Hi everyone, thank you for joining us on Friday for a Ask Me Anything session with myself, Billy, and Chittapol, who's our uh, guest from Thailand. The moment he's still connecting, so it's just myself and Billy. So I guess I should just introduce myself before we start. I'm Tim Phillips. I'm head of the investment advisory for the Wealth Solutions team here at CGS CIMB. So I'm responsible for speaking to a lot of the TRs, trying to get their clients interested in our long-term wealth solutions, also speaking to clients and trying to get long-term capital to come into our wealth solutions team. And I will introduce Billy. So Billy Tor is with me and Kun Jitapal. So maybe Billy, why don't you just give yourself a brief intro first, and then Kun Jitapal, you can go after.
Okay, yeah. Hi. All right. Billy, I'm actually with Prosperous team. So for those of you who do not know, Prosperous is a CGS digital platform. So designed by millennials for millennials, and they do have a lot of write up on education, which is very suitable for new beginners. So this will probably help you guys to understand a bit more on the investment strategies as well as investment basics as well. I'm the head of content and investment lead at Prosperous. So I'm actually based in Singapore, and I do look into the ASEAN market quite a bit, like the Malaysia, Singapore, and Thai market as well. So yeah, that's basically about me. I also wrote a bit on the US stocks, but because the ASEAN Investment Challenge focused mainly on the ASEAN part, so probably let's just focus there. All right, I'll just keep it brief. Digital, maybe what to you? Sorry, yeah, on mute. Yeah.
Okay. Yeah, you can hear me now, right? Okay.
Yep.
So I'm Chittipon from Bangkok, CGSCMB. So basically, I just handling the wealth and macro research here in Bangkok. So I advise people on basic investment and also the fund management stuff like asset management and also stock selections here in Bangkok. So basically, I sit between the asset management department and also the research department. So that is a bit about me.
Thank you. Thank you, Kunjitapal. Thank you, Billy. So I think for the beginning half of this, we're just going to take some of the pre-submitted questions that we had from you, from the audience prior to this, and then we will also be taking questions on our YouTube channel. So please do put in any questions you might have to us, and we'll get to those later. So I think without any further ado, maybe we should get stuck into some of the questions that we have pre-submitted or we have already seen. So I think the first one I found quite interesting. I think maybe Kunjinapal, maybe you can take this first, and then Billy, you can add in with your thoughts.
Yeah.
So when we're investing, how much should you have as a reserve fund? So say you're thinking about putting money to work, maybe you have a war chest of cash. You should have. I think that's the key question.
So yeah. First, so this question depends on the objective of the investment. I think the question mostly come around the investment challenge game. So basically, if you challenge in the game with a short period of time, so basically I recommend you to think about the market condition first. So basically, if you witness the market that have been dropped significantly, so basically it's a good time for you to make a huge reserve. So basically, I would say that 20 to 30% is quite reasonable compared to current level of the risk. But if you go back to real life, most of the time you didn't start the portfolio with 0% of investment. So basically you start with around 80 or 90%. So basically if it is the real investment, I would recommend you, for example, like compare the level of the risk of the market that you are invest. So basically I would recommend you to have like 10 to 15% of the research cash. So it would be used for like if the market drops, so you have an opportunity to buy the dip on the market.
Yeah, that's exactly sense. How about you, Billy? What are your thoughts?
Yeah, I mean, just want to continue from there. Since if it's for the ASEAN Investment Challenge, then of course I would say you should just start right away because you only have a very short period of time to trade. And I would say that you probably just want to strategize it to 50% or maybe even less for longer term, and maybe like 60% is on trading, and you should be trading very often because it's about trading for this short period of time in terms of the campaign, right? Of course, like I think what Jennifer mentioned, you look into the market that you think is at trading at a low valuation and probably wanted to put a higher exposure on the front. But if it's on real investment, I think depends on where your starting point is, and I think a lot of our participants are students and people who are just starting to work. So I think we are starting to work. I think the basic rule of thumb is to have at least about 3 to 6 months of your living expenses as your reserve fund, and I think that's legit. But personally, from my own personal experience, is that because when I actually started investing when I was in my uni days, so I started without any reserve fund per se. So I got my scholarship and then I straight away used the scholarship money and put in. But I was also working at the time. So I think the difference is it really depends on your commitment. If you don't have the commitment like myself at that time, I really don't have much commitment except to study, right? So I don't think that's much of an issue. But I think if you were talking about being more conservative, I think 3 to 6 months of your commitment, that would be very reasonable. So if you are starting to work, you probably need to consider your net income after deducting all your EPF and every taxes and everything. So how much you're paying for your car and stuff, those monthly commitment, because you didn't want to be caught in a position where you're forced to sell, right? So that's basically for a real life situation. But if it's just for the campaign, then yeah, by all means, please start trading now.
Yeah, I would agree. I think it depends on your time frame as well and what you're getting if you're going to be sitting in cash. I mean, at this point in time, maybe you feel like you want a bit more certainty and you want to hold a bit more cash. And if you're getting 5% on your cash, then that's not bad. But in a low rate environment, it's opportunity cost. So I think it depends. I think we should never be fully out of the market. So remember that you should stay invested. And if you dial down your monthly investing, then maybe that's an option if you want to reserve more cash. But I think it's wise to not sell anything and stay invested. I think that's the key. Yeah. Okay, let's move on to another question. Okay, so can you both recommend some technical indicators that new investors should be aware of when, I guess trading, anything technical from the technical analysis perspective that is basic that new investors coming into this should be aware of? Yeah. Billy, do you want to take it?
Yeah, with this. So I think if you're starting, I think just want to share my own experience. And when I first started off, you always have this vision that you can time the market, right? So you look into all the different techniques and try to learn it so that you can, So I practiced quite a bit of it, and I to be fair to those who believe in technical analysis, I mean, if you're doing it better than I am, then by all means go ahead and congratulations. But I personally find that it's really like 50-50, and it depends a lot on a lot of other variables as well, regardless of what the technical indicators are telling me. But some of the few that I started off with are like the moving averages, because it helps me to identify certain trend as well. I think relative strength index is also good because it helps me to see what's the overbought and oversold condition. So it really helps me to see what companies are, the overbought one, what are the hype, the FOMO, what are people chasing after, right? And of course, the oversold conditions are those, why is it so pessimistic? So then it helps me to see where the opportunities or the value buy could be, right? So then, of course, I think the last one that I would probably look into is, like earlier, there's one that's moving averages. Another one slightly more difficult is the moving average convergence divergence. So or MSCD for short. It basically shows a lot more things aside from the trend. It shows the strength of it and some of the other stuff as well. So these are a very good starting point in my point of view. So but of course, after investing, and I mean, I've been doing this for since I was 19, so it's like for 14, 15 years. So I realized that it's really a lot more about looking into the companies that fits into your portfolio rather than just going after what people are saying or the technicals that are shown. All right, that's from me.
Yeah. How about you, Jitapal? What do you take away? What's the key advice for technicals?
Okay, so my key advice to technical should be don't let Billy answer before me because he will tell everything that important already. Okay, so basically, I just elaborate what he has been saying. So basically, when you think about the technical indicator, so what I would like you guys to do is you try to make it simple as possible because you are not the very professional or the very trader that you have to trade every day. So basically, most of the time when you trade a lot by the indicator, most of the time you lose more of the money. So basically, you just choose the basic one that you understand and able to calculate and calibrate itself. So and break it down to in two types. The very first one is the trend spotter stuff like that. That when you see this kind of thing, you continue to think that the trend will follow and the stock will going up, stuff like that. And another one that I usually use is the indicator that you can witness or you can gauge how the stock is dropping. Okay, so you can buy the dip, stuff like that. So you have couple of things. So basically what I have been using, but not of much of the technical indicator that come into my consideration for the long term. The very first one is moving average, of course, which is very easy. And when the stock trade above the moving average, so basically it's trending up. So you can use it as the just a filter to not that time the market, but give the idea that this stock is moving up or moving down. Okay. Another one is the relative thing that I also use it quite some time. Okay. So basically, this is a number that gonna tell you when the stock is dropped more than what it should be on a short period of time. And then you combine this kind of things. It's not just the like Billy say, it's not just about time the market, but you have to understand how the market is behaving. And eventually if you think about the stock have great valuations or maybe great outlook, so the technical indicator just support your timing on buying or selling.
Yeah, sorry, just want to add on this. If especially you're looking at this for the AIC challenge, I think our research team, we have a lot of technical reports as well on a daily basis that you can actually start looking and learning from there. You give you a good starting point, and I think it will help you especially for this challenge.
Yeah, I think you guys covered it very, very well there. Let's move on to the next question. Okay, so how do we navigate a market like this in the current environment where everyone's really scared of buying stocks or holding stocks? What kind of advice do you think you would give to someone starting out in this environment where markets are so volatile, interest rates are so high? It's not the most ideal environment for investors. So what would you say, or what advice would you give to people? Billy, do you want to, or Kun Jennifer, maybe you can kick off with this one.
Okay, I'll start first. So basically, I would recommend you not to scare off the volatility or the market. So basically, I just I have been not the investor, but also like analyst and also the market statistician. So basically, you cannot avoid the volatility. So you have to face it if you want to invest. But and every time, not all volatility is a risk. So basically, I would use one concept, which is the margin of safety. Okay, it is a concept that when you face the market of low volatility, you just need just very small margin of safety. Or maybe when you look at the research analysis of the one stock, they will say that the target price is have an upside or downside, stuff like that. And you think about the margin of safety of the upside that the current price have from different between current price and the target price, stuff like that. So basically, when the market have high volatility, or you think its uncertainty is a lot, you just increase the level of level of margin of safety of yourself. So basically you're just looking at a stock that have more margin of safety, or maybe the current price is drop further, or maybe a lot more compared to the intrinsic value.
Yeah. Okay. Billy, what about you?
Yeah, I think in terms of for the AIC challenge, then basically you don't have a choice, you have to trade. And I think actually the volatility gives you an advantage to a certain extent, because if it's more volatile when you trade, of course you get an upside in terms of whenever you get it right, as compared to when the market is stable. But for those who are looking at real investment, you're looking at longer term, I think a lot of us are still very young, so your time horizon would probably be a bit longer in terms of investing. So I think it is something that you can't avoid. I agree with you, but if you've been investing for a long time, you will notice that it's almost every year that there's a different risk. Of course, right now we talk about a lot more geopolitical risk, a lot more concern about the war that's ongoing and stuff like that, which may seem like a very big deal. So, and I'm not saying it's not a big issue, but it's just that regardless of what risk you're facing, you can't avoid it. So, one of the key way to do it is to really have a balanced portfolio where you have a certain amount, a certain percentage that is on defensive stocks or sectors that can help you to sort of balance or stabilize your portfolio, so that the market, the valuation will not fluctuate so much, right? And of course, another way, you're afraid and you're uncertain about how the current market will be like, whether there will be a bear market or not, is to really consider ETF, because that will give you a better diversification in terms of the stocks. But of course, another way is to keep a bit more cash reserves, like say instead of 50-50 right now, you probably want to put a bit more on cash, 60-40 or 70-30. I think like what Tim said earlier just now, the current 5% yield that you can get from cash is also quite attractive. So those are things that you want to consider in terms of how you balance off your portfolio. But overall, regardless of the market condition I would suggest that you stay invested, because you are in, especially for those of you who are still very young, because regardless of what the bear market is, if you look at historically, right, so it might drop by 30% or more, but eventually it usually recovers back to where it was 5 years. At max, probably it takes about 5 years. So of course, given nowadays we have COVID and stuff, so things have we are probably shifting into a new sort of normal. It might take a bit longer, but even then, I think it's a good sort of way to manage your risk. The last way that I will suggest you guys to do is to consider dollar cost averaging. I think this is a very simple way for people who don't have time to keep monitoring the market. So you can invest consistently, say like every quarter or every half a year, so that will help you to balance off instead of chasing after the market volatility. So
Yeah. I'd add on to Billy's point that every year there is something that is going to be very scary for the market, and the financial media is going to be telling you you've got to sell, or this is something that you can't trust, or the market is going to go down 20%. The truth is that if you have held stocks over the past century, you have made a lot of money over different time periods. So various time periods. It's a fact that stocks are the best asset on a long-term return basis versus anything like bonds or treasuries or gold, for example. So if you have a long-term investing horizon, if you're investing monthly or whatever, longer term, then you really need to stay invested, because the markets have gone up and to the right over 50, 60, 70, 80 years globally. And that's been through what, 2 world wars, the fall of the Soviet Union, the global financial crisis, the dot-com bubble, the Eurozone debt crisis, COVID, and then now we've got interest rates at a 20-year high, right? So this is something that happens every cycle in the market, but the market moves in cycles. But over the long term, the market moves up and to the right. So you really do need to stay invested if you are thinking about the long term. If you're trading, as Billy said, volatility is good. So that's also something to think about on the trading side. Okay, so I think we can move on to the next question. Maybe we can take 1 or 2 more before we start taking the YouTube questions that we have coming in. Okay, so how does the investment landscape in Asia, this is quite a good one, how does the investment landscape in Asia differ from other countries, and what are the unique challenges that this presents for young investors? Billy, any thoughts on that?
Sorry, come again. Sorry.
Yeah. So how does the investment landscape in Asia differ from other countries? And what are the unique challenges that this presents for young investors?
Yeah, I think if you're in Asia, I think this is a very good market to be in terms of the growth that we are seeing. There is a lot of growth opportunities, especially in emerging markets like Malaysia, Thailand, Indonesia as well. I think the one thing that you need to be aware of is the sort of challenges in this market, despite of the opportunities, is that they are always filled with a lot of political uncertainties, risk. I think if you look at Thailand market, for example, or even Malaysian market over the last few years, you've seen, because of some of the political uncertainties, things have been a bit, not as exciting as what we saw in markets like US and stuff. And of course, the regulatory and transparency is also probably not as strong as in developed markets. And of course, last but not least, I think currency risk. If you're investing in Malaysia, for example, I think the last 1 year or so, you notice that one of the things to consider, especially for investors, let's say in Singapore and investing in Malaysia, is the currency risk, right? Because Malaysian ringgit has been weakening for quite a bit. So those are things that you have to look into. But having said this, there are quite a lot of opportunities in these countries. But of course, it's probably harder to reach out to some of these companies if you are not familiar with the market. So one of the things you can do is to leverage on research markets where analysts actually get to talk to these business people themselves directly. So it really helps them to give that sort of exposure, because I don't think a lot of people have that sort of opportunities as what the analysts have. Yeah.
Thanks, Billy. And Kunjitapal, how about yourself?
Yeah, to me, it is quite obvious that when you trade different regions, so basically the politics or the situation in politics would be the big difference compared to another region. And for like Asia, of course, they're gonna be like the country that politicians can move the market around, and for example, like China, and also like Thailand, also Malaysia is quite the market that you have to look compared to the other region, for example, like the US. So basically, it have politics also, but different kind of politics. For European, you will see that there are also politics, but this level of politics will become a little bit more regional than the country. This is the very first one. Another one is when you are trading the market, which is have very small size compared to the global market. For example, like in Bangkok, it's just less than 1% of the global market. You have to understand that the informations or the misprice that you get in the market will be very large, because the very small number of the investor will get into this market, and the degree of efficiency will be decreased by a lot. The last one, I think, is become more prominent is would say the type of the investor or the people you trade together, okay, with you. That would be a huge difference compared to the US, for example, or compared to the mature market. So basically, they usually have asset manager or money manager that fighting with you in the market, okay, and they're also very smart money that try to chase the good stock compared to in Asian. So basically, very small market like in Thailand. So you will face with the small and retail investor that fighting with you, and also the program trading that just looking for the very short period of time. So basically, it would shape your outlook, and also you have to understand them and how they get into the market, or the objective of this investor can be different, and can lead to a different strategy that you tackle the market.
Yeah, that's good. I think maybe from my perspective, if you think about the landscape in Asia, it's as Kunjitapol said, it's like there's maybe liquidity sometimes that's lacking in certain markets. And then the bigger markets have the liquidity, but there's also things about transparency and corporate governance you have to be aware of. But I think one positive thing is that if you're an investor in Asia, you have access to your tip, or at least in Singapore and in Hong Kong and in other countries, you have probably a preferential dividend tax regime versus the US or Europe. So I think the personal investor, it's actually pretty beneficial for you to be in Asia from a dividend perspective or an income perspective. But that's a different type of style. Obviously, capital gains also is usually not taxed. So that's positive, I think, versus what it would be in the US or the UK. So I think there are some positives to the market structure in Asia if you're thinking about stocks. Maybe, I don't know, you're not, I don't know if in Thailand, maybe in Thailand it might differ from Singapore. Singapore, we don't have capital gains tax or dividend tax, but I'm sure there's a slight dividend tax in Thailand and maybe and capital gains.
Yeah, just 10%, and we think about the capital gain tax, but not right now.
Right. Yeah. Okay, so there might be a small tax, but it's probably going to be a lot better than it is in Europe or the US. So I think that's something that you guys can at least be positive about from the Asian perspective. Okay, I think we can maybe take on one more question before we head on to the YouTube questions. So this is quite an interesting one. I guess this is more of a candid discussion. What is the biggest investment mistake you have made? Kunjitapol, do you want to take that one first?
Yeah, sure. But my biggest mistake is happened when I start invest on maybe 15 years ago, stuff like that. So basically I have been thinking that investment is like casino. You don't believe me, but yeah, it was true. So basically, when you try to get into the market, so basically you become like investor first, okay, yeah, and then you get the money, lose the money. But when you lost the money a lot, so most of the time you try to revenge or try to get it back. So most of the time it will make you become more like a gambler compared to the investor. And whenever you think the market is just the casino, so most of the time when I have been losing a lot of money, I just all into one or couple stock, okay, and invest heavily on the riskier side of the market. For sure you will you will be broke.
Yeah.
First time. Yeah.
That's true. Good lesson. Okay, Billy, how about yourself?
I think for myself personally, is when I let emotions drive the decisions. I think I can share this. It's a personal experience because I was working with financial journalism at the time, so you get to see all the news that are going. And back then, I'm not sure if you remember, Trump became the president. So when he actually won the election, there was a slight drop in the market. So it's like the initial panic that people are not comfortable about having him being the president. Right? So because I was reading the news and I've been also carrying the news, so it's like this, so it creates a sort of panic that I sold off some of my holdings earlier than I usually would. So I was just thinking selling off and then buying it back. But so it was never really part of my strategy, but I guess because of the panic and the news and been reading it over and over again, and becomes something that seems so urgent, right? So yeah, so I guess that's probably the biggest investment mistake for me personally. Yeah.
Yeah, I guess for me, it would probably be not thinking about the way I look at dividend investing from when I was younger. I think when I was younger, I looked at dividend investing more on the yield side, and you obviously want a stable yield. You don't want to do crazy yields like 9-10% because something's wrong with the company. But even like 5-6% yields are pretty stable, and you find that in Singapore and other places. But I think I kind of neglected the fact to look at dividend growth, and dividend growth over time is going to be much more important to you as a passive income investor if it compounds over time versus just the yield. Because I found that yield companies like 5-6% yielders, they tend to grow their dividends at maybe 5% max or less, right? It's very stable, but it's not much growth. But if you've got 2-3% yield and you've got growth that can compound at maybe 10, 15, 20% over long periods of time, your cost on the yield when you start investing is going to be very, very high later on. So I think for me, I used to focus too much on that, and I think I've moved towards focusing on the growth, because also dividend growth companies, they are more stable usually, and they're better covered on the dividend side with cash flow, and they can usually pay out a lot better and more securely. So I think for me, that's how I think about dividends, because the dividend really is the addition to the share price, right? So when you think about a share price, or you think about your return, it should be the total return, which is the share price appreciation plus the dividend. A lot of people just tend to think about the yield, and the yield be like 8-9%, but you can get destroyed on the capital appreciation. You can lose maybe like 30 or 40% because the share price, the yield looks great, but the share price keeps coming down. So I think for me, it's been not focusing on that. So I think I would suggest, if you are interested in dividends, really try to focus on the growth and the track record and the sustainability that they can continue to pay. So that would be my lesson, or my biggest mistake rather, from when I was younger. Okay, I think we can move on to the YouTube questions because we've got quite a few. So let me get stuck into the first question from YouTube. Okay, does the rates, I guess this is referring to interest rates from the US, have an impact on our regional markets? Billy?
Yeah, definitely. I think when the interest rates especially over the last 1 year, I think we've seen aggressive rate hikes in the US. I think it makes a lot of sense for investors, especially institutional investors, to divert some of the money away from emerging market and go into US developed markets, because of the if you go into the risk-free rate is already at that level. Why take that sort of risk? I mean, I think that's part of the reason why for example, the weakening in the ringgit as well. So it does have a lot of impact on that front. And so, for example, if you want to go into dividend counters or even REITs, for example, so those dividend yield might not be as attractive anymore, because we are looking at 5-6% compared to if let's say the risk-free rate is also about 5%. Why not just go for that? So that's one of the things that really affected in terms of the regional market. And investors who also wanted a higher premium for growth now. So that's where I think is what has affected some of the market in terms of, especially the regional, as you look into it. Yeah.
Okay.
Great. And Paul, what do you think on the side?
So basically, I would what I witnessed on the market or the experience is that when you trade with the local only, so basically interest rate is not that much of the concern in the market. But when you trade with the foreign investor, stuff like in Thailand, they're going to be like more than 50% of the foreign investor that trade in intraday. So basically, you have to understand that the inflow or outflow can be limited or can be increased by higher or lower interest rate. Thinking about like when you are the US investor and you have the cost of borrowing like 5%, and you guy try to invest abroad, for example, like Thailand, Singapore, Malaysia, stuff like that, and it will be very limited funds inflow going to the Asian or EM region when the rate is so high. It's especially when the rate is very so low. Okay, most of the time you will see that even though we do not have the good growth opportunities, or the stock is just trading with the very, very high PE. Most of the time, if the interest rate is low or the liquidity is high, so it can be that the inflow will come from the foreign and the lift of our market also.
Yeah, I would also say, because the US is the reserve currency, it's involved in about 85 to 90% of global FX transactions. It's really just quite a big part of any global central bank reserves or institutional money. So a lot of people, if they can get 5% on a money market fund in the US, and they're going to be sitting in cash. So we're kind of seeing that a lot recently, is a lot of investors sitting in cash. But as rates come down, that's when money will probably want to come back into the market and see return. So I think the currencies in Asia fluctuate a lot with the dollar strength as well. If the dollar weakens and the markets, there'll be more inflows into markets in Asia. So on the whole, rates are very important. But obviously, you also need to focus on fundamentals of the companies as well as technicals. Okay, so I think we can move on to the second question. I think I'm gonna combine a few of these because there are a couple on technical analysis, but okay, so technical analysis techniques. I don't know if you guys have anything you want to share, but also how much technical analysis do you do versus fundamental analysis? Jitapal, do you want to take that first?
As a strategist, so basically I use very limited technical analysis on my daily basis. So basically we will think about the fundamental first, and then we think about the top down macro theme, stuff like that, inflow outflow more than the technical analysis. And another thing that I have been using, not the technical analysis, is the quantitative stuff of the market, which is the statistic that when you trade in some market condition, for example, like higher rate or higher dollar, how would you expect the market will behave, like a regime more than the technical analysis? To me, when you use a technical, most of the time is when you try to choose or filter the stock that you would like to invest. It's not when you know that which stock that you would invest. Okay.
Yeah, Billy?
Yeah, I personally use more on fundamentals as well because I think I shared earlier, right? Because when I was much younger, I actually did try a bit of technical, just really work too well for me. But I think one way that I do is I do read up a lot on the technical reports that we have sent out, that we have received. One of the reasons is really because it's not my strength. So this is just like if you are sick, right? I don't diagnose myself through the internet and Google. I actually go to see a doctor and get the diagnosis. So I guess if you want, I guess my best advice is ask or look through some of these technical reports that we have and look for some of the technical changes. So like sometimes there will be signal in terms of the different trend and all that. So that's where I look into, and that's how the technical analysis actually helped me. But personally, I focus a lot more on fundamentals.
Yeah, I'm the same. I think if you're looking for stock ideas, sometimes for trading ideas, then for some clients we might have some, like trend spotter and some of the technical ideas, but they're backed up by the fundamental side of the research as well. So I think it's good to use a combination of both, but I'm much more fundamental type of person. So I think technicals are good to learn about the basics, but you really have to love charts and you have to really be a passionate chartist, I think, to get into that and really have a trading plan, etc. We have a lot of technical guys and girls in CGS, but you really have to be passionate about that kind of side. So for me, it's a lot easier, I think, to be passionate about the business and the fundamentals. And I guess that's just really a personal perspective. So whatever you feel you're more comfortable with, but have a framework and a structure around what you're doing, whether you're doing technical or fundamentals, what to look out for. So I think that'd be the key. Okay, let's move on to the next one. Okay, what are some of the best ways to diversify our assets to help us generate passive income through our investments? That's a good one. This is a passive income question. Diversify our assets. So this sounds like it might be a multi-asset approach. So I don't know, Billy, what your thoughts are on
Okay,
that.
I think I can take this. I think it's fine. So personally, I think I diversify my asset quite a bit. So like I think a lot of people, especially if you are say you are based in Malaysia or in Singapore and Thailand, so there is a tendency for us to over allocate our resources into, say, just the Malaysia, your local market, for example. So when I was in Malaysia, when I started off, I invest a lot into the Malaysian market, which I think is the norm. But I would suggest one of the ways to really do it is to start to invest in some of the US ETF to have some exposure in global markets as well. The reason being is very simple. A lot of us have our own pension funds or retirement funds that also invest a lot heavily in the local market. So it's actually good to diversify that way instead of just relying on your own domestic market and your own domestic currency, for example. So you have exposure in US market, for example. So that helps to instantly diversify into a lot. And another way to look into it to diversify is to buy into not just the ETF as well. If you would like to say you need to strategize a bit to have a bit of growth stocks that you want to invest into, and some that are more for safety, that are more for dividend recurring income. So like say probably for myself personally, about 30% of it is in dividend, or those that help to generate that sort of recurring income for me. So it includes like your banks or your REITs. So those are areas that will help to generate that sort of passive income for you in the long term. So that's basically some of the ways that I play with my startup. Yeah. So yeah.
Yeah, Kunjitapal, how about yourself?
So basically, I would separate, the asset that you think you I would separate the asset that I think that they will generate income and asset that will generate capital growth, stuff like that. So very basic of my thought is that if you want the basic income or the passive income, so basically you just avoid the fluctuation first, and you think about how they would generate the income. So diversification will come at the different source of the income you would get. For example, like the very basic things that you will get the income is like the bond, stuff like that. So basically you get a fixed returns when you take the credit risk, stuff like that. So that is one thing. And you think about the riskiest situation that your pot will blow up. For example, like the could be like recessions or maybe the bankruptcy in your country, stuff like that. So the diversification will come out of your risk. Okay, for example, if I invest mostly in the fixed income in Thai market, so basically I have to know that okay, I encounter with the risk that if there are huge bankruptcy in the big company in Thailand, that will be a risk for me not to diversify abroad. So maybe I will start to invest in somewhere else, maybe the property or the REIT in the Asia, other side of the market, or maybe the US, stuff like that. That would reduce the chance that all portfolio of income that you will blow. And another thing, like I said, that you will find the source of income that they will generate. So if it is a different kind of stuff, so basically the diversification will work well.
Yeah, I'd agree. I think diversification is key. For me, it's more on the low yielding dividends, maybe, and then the higher yielding dividends that are less slow at growing. So you have REITs and banks that are very stable, as Billy said, and then maybe you have some interesting ideas that are faster growing dividend names in the US or in other markets in Asia. So just like I think diversify across different sectors and countries as well, and make sure that the dividend is safe and sustainable, and the passive income is able to grow long term, because you don't want to get a situation where they have to cut the dividend, because that's not going to be helpful to you in terms of passive income, right? You want it to be stable or growing. That's the ideal scenario. So I think that would be the key for me. Okay, maybe we can take two more questions. Given that there is information overload in this modern age, how can young people, find reliable advice and discern it from misleading or biased information? Kunjitapal, you wanna take that one first?
Yeah, but I don't know I can answer this one well, because I would flood by the information as well. So maybe what I can advise is a very simple thing that I have been doing. It's like you think about what is your objective first, okay? For example, like when you think about the stock, okay, you go straight to what would impact the company. For example, like the top line, which is the revenue, how can it grow, stuff like that, or maybe the middle line or the bottom line, how this would affect your or your company cost structure, stuff like that. The rest should be something like the trend of the economic, or maybe the news that you will get on a daily basis. After you get the news on the daily basis, you have to match with your objective that I have been talking first. If it's happen to, you know, move up or moving down your revenue, or if it happened to, you know, drag your cost up, or, you know, make your cost dropping down, stuff like that. And you just, you know, take the probability of what that could happen in the real term, or in you know, most of the time it's when it's gonna happen for real. Okay, and that would be, you know, the basic filter that I would use. Most of the time you will get that, you know, you flood with the news, but most of the time the news is not that relevant to the basic revenue, or maybe like the bottom line that you get. So you just, you know, carry, get rid of them, just read through the line, and then, you know, just, you know, multiply it by the probability that this will happen.
Billy, what do you think? What's the best way to discern reliable from misleading info?
Okay, I think it's a bit tricky on this part. I mean, especially given these days with social media, and, you know, you've seen a lot of different sort of information that are available out there. But I agree with Chichipo. I think the first thing is you need to look at your financial objectives, whether you are investing for retirement, whether you want to buy a house, you're trying to get passive income, and then the time horizon that you have, your risk tolerance, and of course the financial condition that you're in. So by knowing that, then whenever you read a lot of different type of information, I think the first thing you need to know is that never invest in something that you are not familiar with or you don't know. I think a lot of people, when they see, you know, that, oh, this stock is going up by, you know, double up in, you know, don't know how many months, and, you know, I gotta buy this, and then there's this FOMO that is there, right? So I just give an example. I think during the COVID period, there was the gloves in Malaysia's the counters that were all flying up, going up at a very rapid pace. So everyone's like chasing after it. And of course, if you're in the first leg chasing after it, you still manage to make money. The second phase, you still probably did, and the third phase, which is the last one, you still make money, but, you know, not as much. And after that, a lot of people lose money from that. But I think the issue was that is that a lot of people don't really look into what they are investing, more on they are trying to get quick money out of it. And I'll be very realistic here. Investment is not a get quick, you know, it doesn't get rich quick sort of scheme for you. So you need to know about things that you want to invest. Say, example, personally, this is my own practices. If I want to invest in Microsoft, so what I did is that I will write it down. Why do I invest in these companies? Right? I'll write down some of the key reasons that I invest into it, some of the numbers that I look into it that I like, that I wrote it down, and I always refer it to back to it, so that I remind myself of the reasons that I'm actually investing into it, and some of the basics that, you know, whether these changes will affect what my base case is. So I think it's important for us to develop that sort of habit. I guess for analysts, you know, because it's part of our job to, you know, write it down and to, you know, to keep track of it. So it's easier. So this is something that, you know, if you want to start off, I think it's a good habit to develop. So this way, you know, even if you hear a lot of different sort of news, you will not be affected. Probably the best. So personally, if I read or hear a lot of different news nowadays, what I did is I'll just take a look at what the news is about, and, you know, put it into my watch list or checklist and see whether I want to look into it or not. So those are things that practical steps that I can recommend you guys to do. But at the end of the day, I think it is important, like what GTPO said, go back to why you invest, you know, that objective. I think then you will know whether this sort of hype suits or fits you. Yeah.
Yeah. I think that's a good point. I think about your risk tolerance and what your objectives are. So your risk is going to determine what assets you invest into or what types of stocks you invest into. And your investment time horizon is going to also contribute to that investment allocation as well. So if you're trading short term and you have a small bit of capital and you don't care if you lose it, then that's fine. You can trade on some GameStop or whatever, and you just put it there and think, I'm okay losing 100% of that. But you're investing long term and you're thinking, you know, that I'm going to put this into the markets for the next 3 to 5 years. You really want to have the mentality that you're not going to take it out if the markets fall or if anything bad happens. In terms of the information, I think it's key to really discern whether an issue that affects a company is structural or it's just a bad quarter in earnings. Because some things get sold off because, you know, they didn't, I don't know, like they didn't meet analyst expectations and guidance was guided down, or something that is really quite immaterial in the long term. But it could be just a cyclical issue for the business or the industry. Whereas something which is maybe massively structural, like there's a continued decline in the number of users for the business, or there's a continued decline in revenue, etc. That's something that's a bit more, you need to pay attention to. But I think at the end of the day, you really need to go straight to the company source and understand the company, look at the company investor relations, understand the reports, go through the 10Ks, the 8Ks, like the 10Qs, like the annual reports, understand what the company does. And Billy was right. I think journaling is quite a good idea, writing down why you like it. I would add maybe also write down some reasons why you should hate this stock, because a lot of us really fall in love with stocks and we fall in love with the idea and the story. And there's some really great businesses out there. So even Microsoft and Apple, they're great businesses, but there are certain reasons why you shouldn't like them as well. So I think it's important to be aware of, like, even if you really love this stock, why should I not like it as well? And what's the, what are the obstacles and challenges for the business? And I think that makes you a little bit less, it makes you less subjective in thinking that I'm going to own the stock no matter what. You should think about the threats to the business and what could change, because I think that's important when you hold at least individual stocks. You have to be aware that they're going to have a much more outsized impact on your portfolio than owning an ETF or a market. So it's a very different allocation and mindset, I'd say. Okay, I think we've got time for the last question because we've answered one on investment landscape already. So I'm going to start. Okay, so starting out, should we enter the Singapore market? I guess, Kunjitapal, this would be the Thailand market for you, or other countries like the US, because the US is the largest market. So Billy, what do you think?
Yeah, I think it's important to start with your local market. I do think it is important. So if you're in Singapore, it's good to start with the Singapore market because you're more familiar with companies there. So like if you're in Singapore, like Kimley, you know that own all these different hawkers stores but if you're someone from Malaysia or Thailand, you probably don't know what this company is as well. So I think it's good to start off with the local market and then slowly diversify into the more developed markets like the US market, which I think is necessary. I think I've addressed it earlier when I say that, I think owning investment that is just based on your own local market for too long a time is dangerous. But starting out, get used to it, understand, be familiarized with all these different investment jargons as well. So it helps you, when you go into the more developed markets like the US market. So yeah.
Okay. To me, I'm not that, the very cheerleader of the Thai market, but as the investor, I would suggest you have, some edge over the market. Okay, when you are in Southeast Asia, you know suddenly in the mind that you have very good grips on this kind of company, or you have very unique information, or maybe the information that you have more than the people abroad. Okay, and the market is quite small, so basically they're going to be much more upside or misprice that can happen to the market like this. I think is that the age and the opportunity that you still have to invest in Singapore or maybe in Thailand. Another thing is that when you invest in very small market, or maybe the market that not that much of the big trend, or that not the global market, so the upkeep or maybe the knowledge that you will get to the market at the very starting point, it will be very high, very similar to global stock market. But when you reach some certain point, your knowledge will be gain very fast and very a lot more. For example, like in Thailand, if you know the 50 or 100 stocks, so in next decade, this stock will stay with you for quite some time. Okay, they will stay in the market for quite some time, and your knowledge that you invested in will be still relevant compared to the big market. If you invest in the large market like US, so basically you get the knowledge of the company that can be like global or the big scale of the market, but you have to understand that you don't have much age compared to the Asian, and you do not have and you have to study more, and if there a lot more to come, or information that can be flow out.
Yeah, that's a good point. I think like Thai and Singapore markets, smaller markets are more inefficient, right? Whereas the US is so big. The US stock market is 60% of the value of all global stocks, so it makes up 60% of the global stock market. So it's very outsized. I mean, Apple by itself is worth more than the entire UK stock market. Okay, so kind of gives you the context of how big these companies are and how liquid the US market is. So going back to starting out, I think it makes sense to start out in your home market with what you're comfortable with. I think Singapore is a very reliable market. There's some really good dividend payers like banks and REITs. And I would say be more comfortable holding the big, large blue chips. I would be if younger, just understand that these have more liquidity and then they're more reliable and they're strong in times of stress, like now. So a lot of these larger REITs with strong sponsors, a lot of the large banks in Singapore, they're all very reliable dividend payers. And I think it gets you a bit of exposure to the stock market and understanding what moves the stock prices, which is good. But with the US, I think you really can't be not invested in the US. So everyone that I'm know of is either invested in their home market and then the US. They're rarely invested in a third country. They might have some exposure to maybe China, but very, very minimal. So it's usually either you're invested in Singapore in the US, Thailand in the US, Australia in the US, UK in the US. So you have your home market and then you have the US because the US is so big and outsized. And so I think it really is difficult to ignore from a long-term perspective. But it's good that to start out in your home market, I think, to understand, because you're probably more familiar with the companies here that are listed, you know them and you interact with them every day. I would say in the US market, don't be put off by the dividend tax, which is 30%. A lot of people I hear say, Singapore is for the income and US is for growth because there's no point buying dividends. But if you can grow your dividends fast over 10 years, 20 years, 30 years, that dividend yield and that dividend tax is going to be meaningless because a lot of companies in the US, if you find great companies in the US, they can grow their dividends compounded every year 25%, 25% over 10, 20, 30 years. It's very, very difficult to find companies like that in Singapore. There's the banks do well, but they're maybe 10%, but they're not. It's again a lower yielding, like higher tax situation, but you've got great companies in the US. So I really suggest do not be put off by this whole dividend tax perspective and that whole argument of, oh, dividends is only for Singapore and growth is only for the US. I think is completely wrong way of looking at it, because if you're a long-term investor, you want the growth of that dividend to be very, very fast. You want it to be growing at 15, 20, 25% consistently. And the US is the only market really, I think, that can deliver that kind of growth because of the opportunity set that the dividend, market in the US offers, and the market that they're serving is so big in the US. And really you see dividend aristocrats in the US, they pay dividends however for how many years. So there's really a culture of dividend paying in the US, whereas in Asia, it's a bit more of a new thing. I mean, I'd say it's not as a sacrosanct sort of corporate practice. So the companies in Asia might be okay cutting a dividend, whereas in the US, they'd be really loath to cut their dividend. They might pull back on share buybacks and stop that. But if they've been paying a dividend every year for 50 years, they do not want to cut the dividend. So I think it's important to think about it holistically from Singapore and from the US, and not just think this market is for this and this market is for that, because that's, I think you'll not benefit from that longer term. Okay, I think that's it, guys. We've wrapped up and we've hit it on the head. 6 o'clock, nearly 6 o'clock, so 1 hour. Thank you, Kunjitapol, and thank you, Billy, for joining tonight. And thank you, everyone, for tuning in and listening to us on the AMA for Friday afternoon. And I hope you found this session insightful and useful. And best of luck on your investing in future. Thank you.
Yeah.
Thank you.
Bye.
Bye. Bye.